Welcome to 𝗀𝗡𝗏 Estate, your trusted channel for property investment and financial advice. Today we're embarking on an exciting journey to explore a crucial part of the financial world, the money market fund. In the ever-evolving landscape of investment, it's essential to have a clear understanding of where and how you're investing your hard-earned money. Therefore, we've prepared a comprehensive guide on the 10 things you need to know before investing in a money market fund. This guide will help you navigate the complex world of investment and make informed decisions that align with your financial goals. From the safety of money market funds to the impact of inflation, we've covered it all. So strap in as we take you through this enlightening journey. Stay tuned as we delve into these crucial points. And remember, knowledge is power when it comes to investment. First things first, what exactly is a money market fund? Well, imagine a massive pot where investors pool their money. This pot is then used to purchase short-term, high-quality investments such as treasury bills, commercial paper, and certificates of deposit. That's a money market fund in a nutshell. Its purpose? To provide investors with a safe place to invest easily accessible, cash-equivalent assets. It's like a savings account with a dash of interest. They're widely used by individuals, businesses, and institutions alike to manage their cash and short-term funding needs. Within the grand scheme of the financial market, money market funds reside on the less risky end of the spectrum. They're considered a low volatility, low return investment, but with the added advantage of higher returns than a typical savings account. Now that we know what a money market fund is, let's move on to what you need to know before investing. Point number 1, the safety of money market funds. Money market funds are often seen as a safe haven for investors. They are considered low-risk investments because they are composed of high-quality, short-term securities from government, banks, and corporations. These funds aim to maintain a stable value of $1 per share, making them an appealing choice for those who prioritize safety over high returns. However, it's crucial to remember that the value of these funds can fluctuate, albeit minimally, and there could be instances where investors might not recoup their initial investment. In rare cases, the funds can even break the buck, which means the value falls below $1 per share. While these situations are uncommon, they do highlight the fact that even safe investments carry some degree of risk. So, while money market funds are indeed a safer bet, they are not completely risk-free. But remember, low risk does not mean no risk. Point number 2, liquidity of money market funds. Now, we're diving right into the world of liquidity. It's a term you'll hear often, and rightly so. In the realm of finance, liquidity refers to how quickly an asset, in this case, money market funds, can be converted into cash without affecting its market price. So why is this important? Picture this. You're faced with an unexpected expense. You need cash, and you need it fast. Money market funds shine in this scenario. They are highly liquid investments, making them a go-to source for emergency funds. They can be easily bought and sold, providing you with the cash you need when you need it most. But remember, while liquidity is often a good thing, it's not the only factor to consider when choosing an investment. Risk, return, and your personal financial goals should also be taken into account. Liquidity is key in any investment, especially for those unexpected moments. Point number 3, the return on investment. Now let's talk about the potential returns of investing in a money market fund. These funds are often seen as a safe haven for investors, providing a stable place to park cash and earn modest returns. The key word here is modest. Because money market funds invest in low-risk securities, like treasury bills and certificates of deposit, they typically offer returns that are slightly higher than a regular savings account, but lower than more volatile investments like stocks or bonds. This is a trade-off you make for the security and liquidity these funds offer. You're not going to get rich quick, but you're also not going to lose your shirt. It's a slow and steady approach to growing your wealth. And as the old adage goes, slow and steady wins the race. Remember, with lower risk comes lower return. Point number 4, understanding the fees. When you invest in a money market fund, it's crucial to be aware that you're not just handing over your money and waiting for the returns to roll in. There's a cost to this service, and it often comes in the form of fees. One common fee is the management fee. This is the price you pay for the expertise of the fund manager and their team. They're the ones who are analyzing market trends, making investment decisions, and basically doing all the heavy lifting. Other potential fees could include distribution fees, transaction fees, or even account maintenance fees. These can vary widely between different funds, so it's important to read the fine print before you invest. And remember, these fees eat into your returns. So, a fund with high fees needs to deliver significantly higher returns to be worth it. Always factor in the fees when calculating your potential returns. Point number 5, the importance of diversification. Now, let's talk about why diversification is crucial in your investment journey. You know the old adage, don't put all your eggs in one basket. This couldn't be truer when it comes to investing. Diversification is all about spreading your investments across various asset types, sectors, and geographical regions to reduce risk. It's like a safety net for your financial portfolio. So, how do money market funds fit into this diversification strategy? Well, they are generally considered less risky than stocks and bonds. This makes them a good option to balance out your portfolio, especially if you have a significant portion of your investments in high-risk assets. They can provide a steady income stream while still offering short-term liquidity. Remember, diversification doesn't guarantee you won't face losses, but it can help to minimize them and even out the bumps on your investment journey. And always remember, never put all your eggs in one basket. Point number 6, the impact of inflation. Let's delve into this a bit. Inflation, in its simplest terms, is the rate at which the general level of prices for goods and services is rising. Now, how does this relate to money market funds? Well, it's like this. If inflation is on the rise, the purchasing power of your returns could diminish. Here's a scenario. Imagine you've invested in a fund that offers a 3% return. But if inflation is at 2%, your real return is just 1%. In other words, what you can buy with your returns is less than what you could at the time of your investment. That's why, even though money market funds are considered safe, inflation can erode your actual returns. It's like a silent thief chipping away at your earnings. So remember, inflation is an investor's silent enemy. Point number 7, the role of interest rates. Now, we've all heard of interest rates. They're a part of our daily lives. But what role do they play in money market funds? Well, they have quite an important role. You see, when interest rates rise, the value of existing securities decreases. This is because new securities are issued at these higher rates, making the older, lower-yielding ones less attractive. On the flip side, when interest rates fall, the value of existing securities increases as they yield more than the new, lower-yielding ones. Essentially, the fluctuation of interest rates can significantly impact the returns on your investment. So, when considering investing in a money market fund, it's crucial to keep an eye on the prevailing interest rates. But remember, while higher interest rates might seem appealing for the higher returns they offer, they also come with an increased risk. Interest rates can be a double-edged sword in investment. Point number 8, the importance of financial goals. Setting financial goals is like setting the destination for your investment journey. Without a clear destination, you might find yourself wandering aimlessly in the vast financial wilderness. Money market funds serve as a reliable vehicle that can help you reach your financial goals. Whether you're saving for a down payment on a house, funding your child's education, or building a retirement nest egg, money market funds can play a crucial role. Their relative stability and liquidity make them an excellent choice for investors who have a clear timeline for when they will need their funds. Remember, every investor's financial goals are unique, and your investment choices should reflect that. So don't let the noise of the market distract you. Stay focused on your financial goals and make investment decisions that align with them. Align your investments with your financial goals. Point number 9, the value of research. When it comes to investing in money market funds, research isn't just a recommendation, it's a necessity. It's crucial to understand the fund's historical performance, its managers, and the securities it invests in. This isn't a process you rush through, it's one that demands time and effort. Consider the fund's past performance. While it's not a crystal ball for future results, it can provide insights into its volatility and potential returns. Look at who's managing the fund. Their experience and track record can impact your investment's growth. Review the securities the fund invests in. Are they stable, reliable entities, or do they carry more risk? Remember, it's not just about finding a fund with the highest returns. It's about finding a fund that aligns with your risk tolerance and investment goals. So as you dive into the world of money market funds, remember to do your homework before investing. Point number 10, the need for professional advice. The world of investing can often feel like a labyrinth, filled with complex jargon, intricate strategies, and countless financial products. This is where professional advice comes in handy. A seasoned financial advisor not only helps you navigate these complexities, but can also provide a tailored investment strategy based on your financial goals and risk tolerance. Investing in money market funds is no exception. With their expertise, they can help you understand the nuances, including the fund's objective, its underlying assets, and the potential risks and returns. Remember, while money market funds are generally considered safe, they're not entirely risk-free. An advisor can help you assess these risks in light of your overall investment portfolio. And let's not forget, professional advice can save you from costly errors, ensuring your hard-earned money is put to its best use. Because after all, a trusted financial advisor can be your best investment. We've covered a lot of ground today. We've explored the world of money market funds, delving into what they are and the safety they provide. We've touched on their liquidity and the potential return on investment they offer. We've dug into the fees associated with these funds, the importance of diversification, and the impact of inflation. We've also discussed the role of interest rates and how they can affect your investment. We've stressed the importance of aligning your investments with your financial goals and the immense value that research can bring to your investment journey. Lastly, we've underscored the need for professional advice when navigating this complex field. Investing in a money market fund is a significant decision, and we hope that this video has equipped you with the knowledge and confidence to make that decision wisely. Thank you for joining us today on 𝗺𝗪𝗧 estate. Don't forget to subscribe for more insightful content.